Tariff, is it going to have a significant impact on India's productivity and prosperity or bilateral relationship? Are we marginalized by United States? I don't think so. It's an opportunity in pursuit of India's progressive vision and execution. The reasons are obvious. Sectors are more important: textile, apparels, gem and jewelry, seafood and fisheries, chemicals, leather goods, carpets and handicrafts, auto components, furniture and home decor, footwear, animal products, electrical machinery, industrial tool and fasteners. We have to find alternate route for exports. And that's the challenge we have. We have reasons to believe a Russia team which is visiting in September for free talks might counterbalance. India-EU FTA talks also entering the final lap. That's going to be an opportunity. It is US to have an early resolution of tariff mess which they have created. Despite Trump tariffs, India to surpass United States in purchasing power parity. India will become the world's second largest economy by 2038. It's a PPP-based projection, strong growth differentials, resilient fundamentals. Domestic demand is our strength. Tariff impact is minimal. US tariff may have 0.1% of India's GDP growth, may shave. But debt advantage, India's debt to GDP ratio is projected to decline, unlike rising ratios in the US, China, and Germany. Our reforms are our backbone. GST, UPI, and production-linked incentives enhance competitiveness and economic depth. So a global ranking shift is visible. India will overtake Japan and Germany by 2028 in market exchange terms, becoming third largest before rising to second. Central planning support measures for export amid tariff shock. Very important. Emergency credit lines proposed, moratorium on export loans, extended realization period. 2 sub-schemes India has launched. E-commerce export hub is expedited. Sectoral impact is acknowledged. Gems or textile, as I said earlier, seafood or electronic flagged as hardest hit by the US tariffs. That's why we are encouraging diversification. This is a wake-up call to expand India's export basket and markets. Mind you, GST reforms is going to offset the growth drag from 50% US reciprocal tariffs. That's going to be 2 slab structure plan, GST reforms, lower rate on common goods, durable to get relief, consumption-led growth, mild fiscal impact it will have. GDP forecast is revised in substance. Understandable. So it's an opportunity in tandem. The India and Japan, if they are boosting the trade amid tariff war, that's an opportunity. That's why Indian Prime Minister and Japanese Prime Minister got together to reduce the impact of tariff tension created by United States. SME entered global supply chains. Japanese firms integrate India's small business into electronics and automotive networks. 13 billion is committed. Semiconductor ecosystems grows. Defense tech collaboration is moving up in the value chain. Bullet train project is revived. Strategic alignment deepens in substance. Reserve Bank of India is saying clearly rural demand remains strong. Inflation outlook benign. Monetary policy is steady. US tariff, of course, it poses risk, but external sectors are stable. Credit growth is improving. Bank credit to MSMEs in specific terms. Fiscal support will continue. Government spending and transmission of earlier rate cuts are helping sustain aggregate demand. We have seen the reflection of S&P rating is boosting up the economy. Indian economy to sustain high growth momentum in the coming quarters. Of course, first quarter GDP performance commendable because of broad-based sectoral gains, minimal tariff impact, robust rural outlook, urban demand traction, investment momentum, fiscal support measures, stable growth forecast. Even for 2026 GDP, if you look at the big picture, factoring the US tariff, incremental tariff, is going to be between 6.3 to 6.8, reflecting resilience against global headwinds. We're also on track to achieve fiscal deficit target of 4.4% for the year 2026. Fiscal discipline is reaffirmed, strong macroeconomic fundamentals, capex-led growth, private consumption is upticking, temporal mismatch clarified, revenue mix is evolving, net tax is dipping, non-tax revenue is surging. So broad-based sectoral support is happening already. Manufacturing, construction, services, agriculture are all playing a big role. Long-term consolidation path, that is 4.4% target, aligns with India's roadmap to reduce the deficit below 4.5%. Indian exporters are also shifting focus to new markets amidst US tariff hike. Exporters pivot to UAE and Bangladesh. Italy and Belgium gain traction. German jewelry shift underway. Exporters to UAE surge 76%. We are seeing it. Rice export diversification to Bangladesh, Togo, Kenya. Government maps new markets. EU, UK, Japan, Australia, with long-term entry to Latin America and Eastern Europe. Structural reforms are going to help to consolidate our way forward. To sum it up, this tariff is not going to pose a major threat to India. Rather, India is going to convert this by multilateral partnership as an opportunity.